Black empowered business group Morvest posted a 20% jump in full-year headline earnings per share to 6 cents, while the group's revenue for the same period grew 16% to 807 million rand. We cross now to the JSE to unpack those numbers with the company's CEO, Mohammed Varachia. Thanks so much, Mohammed, for joining us this morning. Well, we started to see your new business strategy and plans to rebrand take effect at your interim results earlier this year. At the full year stage, give us some perspective on the year that was for the company. It certainly looks impressive looking at some of those headline figures that I've just come across.
Thank you. Well, yes, it's been quite an interesting year for us. We've finalized all our restructuring as an organization. And I think particularly exciting for me is the fact that we've been able to deliver the results, show good growth. And I must add that all of that growth has been organic. We've also seen the listing move from Alltex to the main board on the business support services sector, as well as the rebranding of the group taking effect this year. So a lot of the legwork and the restructuring that we had indicated to the market a year before has been completed well ahead of schedule. And I'm happy to say that that's been successfully concluded as well, and reflecting in the numbers. So I believe we've got a very good platform for growth going forward now.
That amidst what kind of market conditions at this stage of the game, Mohammed? Because, market conditions, looking at your report, are said to remain challenging in a number of the key markets, particularly in South Africa over the next 12 to 18 months.
Yes, we do still expect that, the economy will continue to present some challenges to us. That was the outlook that I shared with a lot of the investors and shareholders a year before. But I must say, despite that, we've been able to deliver some good results, and I'm hoping that we can still continue the same trend. One never knows with where the market is, where the recession has been taking effect on some of our clients in particular. And so I think the outlook is one that forces us to take a very prudent approach to where we're heading. But as I say, notwithstanding that outlook, we still remain confident that we have very good contracts in hand, well over 2 billion rand still in the pipeline over the next 5 years. And I'm confident that the group will still be able to deliver very good results and strong cash flows.
Of course, one of the factors that's been holding you in good stead has been your JV with the partner in India. I mean, at the time that deal was done, it was seen as the best solution to counter the international pricing power, which at that stage had been pressurizing the company's ability to win work across the continent. How has that come to bear? What are some of the, the strengths you've managed to leverage off from that partnership?
Well, you're absolutely correct. I think the pricing pressure was quite significant if I had to just look back some 3 years ago, particularly in the African market where there weren't any regulatory preventions as we've got in South Africa, as an example, the BEE codes, etc. So we did find some stiff competition, and I think it was strategically, undoubtedly the right move. And as you've again alluded to, we've been able to demonstrate good results on the back of the Indian joint venture. So some of the benefits coming through there has been access to much more effective and efficient structures, which lends itself to cheaper products, which we were able to then compete on. As an example, in some parts of Africa, pricing is an imperative, as we all know. So we were able to get in there with this without compromising the quality of the products that we were known to be delivering as an organization. So we were able to deliver top quality products at the best pricing. And I think more importantly, it gave us access to quantities that we were unable to do in the South African market. So the manufacturing capacity that was presented by the Indian operation started to help us quite substantially, and that's evident in our numbers as well.
Of course, we're well aware of your operations in Nigeria. What stride are you making on your Africa strategy as a whole, Mohammed?
It's been quite exciting again. We've seen a bit of a turnaround, if I should say, in the Nigerian market, particularly on the back of what we've seen as far as RICA is concerned and the similar implementation in Nigeria. So we did expect a bit of a slowdown last year, but that slowdown wasn't as substantial as we had expected. Following on the growth of the packaging business and the print business in Nigeria, we've also launched the rest of our ICT offerings in Nigeria. In fact, a month ago we launched Morvest Nigeria, appointed a full-time MD and chairman that is a local-based businessman. And we believe that on the back of that, we'd be able to see some significant growth in the Nigerian market. The rest of Africa, we remain confident, is going to present some good opportunity. And again, I think it's important for the viewers just to understand that Morvest has been successfully operating in the African market for over 7 years. Yeah. And it's not a new venture. So we've been, again, leveraging off that extended experience and platform that we've built over the past 7 years now.
Well, Mohammed, I've got Mitchell Ganaway from Tebe Securities with me at the desk here in studio, and he's got a question for you, Mitchell.
Yes.
Hi, yes, good morning, Mohammed. I just want to ask, 90% of your revenue that I saw in the interim results came from South African operations. With this joint venture that you've got going on with India, as well as your Nigerian operations, where do you see your revenue from a geographical point of view? What does it look like the next few years from now?
Well, thanks for that. We basically, if you look at, well, let's position it this way. The current year, absolutely correct, 10% of our revenues coming from outside of South Africa. The outlook for the next 3 to 5 years, I believe, will see a much more aggressive growth in the markets outside of South Africa. I should rather position it that way. So the outlook over the next 3 years is certainly to get the rest of the business outside of South Africa up to about 20-25%, we anticipate, while still seeing organic growth in South Africa. So that's quite a substantial growth outside of the South African borders. And again, we see particularly the growth coming from Africa. We have had operations in the Middle East, which has been fairly slow on the takeoff, and just given some of the unrest, political unrest, etc., we have pulled back from those markets. So the real growth, we believe, will be outside of South Africa, and the emerging market strategy that the group still holds as a strategy will still be what we'll be focusing on.
Mohammed, very quickly, because we've officially run out of time for this conversation, but are you pursuing then complete organic growth when it comes to chasing those targets, or are we looking at more acquisitive growth coming through?
It's really a combination. I think there'll be a bigger dependency on organic growth, and I must say that there will still continue to be acquisitions, given that the group is cash strong as well.
For now, of course, as Mohammed highlighted earlier, all the revenue growth that we have seen has been purely organic. Mohammed Varachia, CEO of Morvest, joining us live from the JSE this morning. Thanks so much for your time.